The BigBear.ai Holdings Inc. stock, trading under the ticker BBAI, closed yesterday at $6.78 per share. Since the market is closed as of this analysis, Friday, October 24, 2025, 8:14 p.m., we're using the final print from the Thursday's trading session. This stock has been an absolute flashpoint, a case study in AI sector volatility and the tension between perceived future value and current financial reality. While most retail investors are simply focused on the headline-grabbing 300% plus surge we've seen over the last 12 months, which they attribute entirely to the current AI hype cycle, the deeper and more crucial insight is that the massive institutional buying that fueled the move is actually starting to quietly slow its pace, even while short interest remains stubbornly high. This divergence, institutional accumulation possibly peaking versus a persistent entrenched short thesis, is the real story driving the choppiness and the huge intraday swings that characterize BBAI right now. The expectation is that this is a simple AI momentum play that will track other software names, but the reality is this is a highly technical military-industrial software stock whose movement is more about contract visibility and major institutional position building than pure widespread AI excitement. The general belief, particularly in retail trading circles on platforms like X and Reddit, is that BBAI is a clear mini Palantir with an open-ended growth path, especially after its recent partnership announcements and the increased focus on edge AI for defense. Traders are excited by the news of its biometric system, Veriscan, being deployed at major airports like Chicago O'Hare, and the strategic alliance with T-Second for AI-enabled edge infrastructure, both of which suggest a broader application beyond its deep-rooted government work. This narrative has created a strong sense of hope and a to-the-moon mentality, especially among newer traders who see a sub-$10 AI stock as an accessible ticket to generational wealth. However, the contrarian take is that the stock's current valuation, trading at roughly 13 times projected 2025 sales, which is astronomical for a company that is still losing significant capital, suggests that nearly all future success is already priced in, and then some. The challenge here is the reality of the company's financials. Their Q2 2025 revenue came in at $32.5 million, an 18% decline year over year, and they had to cut full-year revenue guidance from roughly $155 million down to a range of $125 to $140 million. Management also had to withdraw profit targets. That is a significant and sobering reality check against the euphoric expectation that the stock is a guaranteed winner. Retail enthusiasm is running headfirst into the cold, hard wall of disappointing fundamental data and reduced forward guidance. The recent stock movement perfectly illustrates this tension. The stock's jump in October, which saw it surge by over 20% on the day of the T-Second partnership announcement, was a classic news-driven spike. Retail investors celebrated, viewing it as concrete proof that the company is successfully diversifying and capturing defense contracts in high-growth areas. The trading volume during that period was truly immense, a clear sign of retail stampede following the news headline. However, looking beneath the surface, the technical action is more nuanced. The stock has struggled to maintain momentum after each euphoric spike, often giving back a significant portion of its gains in the following sessions. This points to two forces at play: profit-taking by early investors and continued calculated pressure from short sellers. The latest short interest data is absolutely critical here. It currently sits at roughly 18.38% of the float, representing nearly 80 million shares shorted. With a short interest ratio, or days to cover, of only 0.62, the short side is massive but not necessarily trapped, as volume is high enough that they could cover quickly. This huge short position is a dual-edged sword. It's the primary source of the retail frustration, the belief that the stock is being manipulated or held down by big players, but it's also a massive potential catalyst for a short squeeze if a substantial positive surprise hits the wire. The ongoing high off-exchange short volume ratio, hovering around the mid-35% range, is what feeds the popular narrative of covert suppression, creating genuine distress and anger among community members who feel they are battling a rigged system. Shifting to the institutional side, the positioning provides another layer to the story that directly contradicts the retail meme stock label, often applied to BBAI. While large institutions like Vanguard and BlackRock have substantially increased their holdings in the last reporting quarter, adding tens of millions of shares and raising their combined ownership to over 10% of the company, this accumulation is not necessarily a vote of confidence in near-term profits. Instead, it's a strategic bet on the long-term defense AI budget and BBAI's secure positioning within it. They are buying a strategic asset at what they view as a favorable price point, betting on a successful turnaround over multiple years. This is a complete mismatch with the typical retail holding time, which is focused on quarterly earnings or weekly news flow. The frustration voiced in online communities often revolves around the company's history as a special purpose acquisition company, or SPAC deal, and the resulting dilution from warrants that have been exercised, which directly counters the rising share count and dilutes any gains. This frustration is legitimate. The shareholder equity has been negatively impacted by past financing structures, which makes it harder for the stock price to truly reflect its contracts. Insider activity, showing significantly more sales than purchases over the past 12 months, also adds fuel to the fire of retail skepticism, regardless of whether those sales are for planned tax purposes or actual lack of confidence. The sheer number of shares sold by executives is a visual data point that's hard for a hopeful retail investor to ignore. To truly understand BigBear.ai Holdings, you have to look past the AI buzzword and see the underlying business model. The company is a pure-play decision intelligence provider, primarily to the U.S. national security apparatus, intelligence community, and critical infrastructure sectors. Their core offering is a fusion of data ingestion, artificial intelligence, and predictive analytics delivered through their Conductor AI platform. Think of their work as providing an extremely sophisticated real-time command and control dashboard for complex operations. For the military, this means predicting adversary movements or optimizing resource deployment. For commercial clients, particularly in the digital identity space via the Pangiam acquisition and Veriscan, it means rapidly processing biometric and travel data. The contracts they secure are generally high-value multi-year awards, providing a substantial, if somewhat lumpy contract backlog, which stood at $380 million at the end of Q2 2025. This backlog is the foundation of the bull case, representing a significant amount of expected future revenue. Older reports from previous years show the company that was struggling to transition from a government services model, where revenue is low margin and project-based, to a high-margin software-as-a-service model, a transition that is still very much in progress. This transition is why analysts are split, with some issuing buy ratings with price targets around 8, while the average target sits closer to 6, suggesting little to no upside from the current level. The bull case is based on the backlog converting into high-margin software revenue. The bear case rests on the historical inability to do so efficiently, coupled with persistent losses. Looking ahead, the tension between what traders hope for and what data suggests will be dominated by the upcoming Q3 2025 earnings report, scheduled for November 10th. This is the next true catalyst. The market is watching to see if the recent partnership announcements and new contract awards, especially in the growing edge AI space, can reverse the declining revenue trend and show a clear path to improved gross margins. The narrative in retail spaces will absolutely hinge on any slight beat or miss. If they can demonstrate that the newly won contracts are beginning to successfully translate into higher margin software revenue, expectations will exceed reality, and you could see a rapid and violent upward move amplified by the persistent short interest finally being forced to cover. Conversely, another revenue miss or a further downward revision to guidance would validate the short thesis and could trigger a significant and equally rapid sell-off, with many retail investors who bought at the top feeling completely demoralized. The key data point isn't just revenue, but the trajectory of their adjusted EBITDA, which management is aiming to keep in the negative single-digit millions for the full year. Any beat there will be viewed as a clear sign of fiscal discipline finally paying off. Comment below how much you think the share price will jump or fall after their November 10th Q3 earnings report. The future outlook for BigBear.ai is entirely framed by its unique position as a defense-focused AI play in a world that is rapidly weaponizing data. Opportunities exist in the sustained and increasing U.S. defense budget for AI, and the ability to continue their expansion into critical infrastructure like airports and supply chain logistics, proving the commercial viability of their defense-tested technology. The risk, however, is significant. Competition from much larger, better-funded rivals like Palantir and 𝐶.ai, and the continuous need for costly research and product development in a constantly evolving technology space. The largest risk is simply that the company fails to efficiently convert its existing contract backlog into profitable recurring revenue, remaining a high-potential but perpetually unprofitable entity. Retail sentiment will remain a massive factor in volatility. The excitement around being a mini Palantir is intoxicating for the crowd, but institutional logic demands a clear path to profitability. The ultimate reality is that BigBear.ai Holdings is not just a simple AI stock, it is a highly speculative growth play tethered to the complexities of government contracting and the ongoing financial restructuring from its SPAC past. It's a stock whose single contract win can cause a 20% surge, and a missed earnings target can erase it just as quickly. In summary, the core insight here is that the market's expectation for BigBear.ai Holdings is rooted in a simple AI momentum narrative, fueled by high-profile defense and security partnership headlines and amplified by a passionate, yet frustrated retail investor base fighting a battle against high short interest.
The reality is far more complex. This is a military-focused decision intelligence provider facing declining year-over-year revenue, significant losses, and a critical need to prove its ability to turn a substantial contract backlog into sustainable, high-margin software revenue. The sheer volume of institutional accumulation, however, does provide a strong signal that major players see a long-term strategic value here that the short-term financial data does not yet reflect. The upcoming Q3 earnings call will be the moment of truth, testing whether the recent news catalysts can finally tip the scales of reality in favor of investor expectation, or if the skepticism surrounding its profitability will continue to dominate the trading narrative and lead to a significant price correction, disappointing a legion of hopeful traders.